Hi, everybody. This is the Physics of Bitcoin show. Today is July 15th, 2026. I am in Torino, Italy, at our Scientific Bitcoin Institute headquarters. You can see our flag over there, pennants, whatever you want to call it, when we do our battles against fiat. And Stephen is in Thailand, like always. We're planning soon in August to actually meet. I think it's the first time physically in Hong Kong for Bitcoin Asia. So if you're attending the conference and you want to meet both of us, hopefully I will have some books copied, Physics of Bitcoin book. That if you're not aware, we have a full book about the power law theory. It's actually sitting on my desk. You can find it on Amazon. Maybe we can eventually also translate it in Chinese, in other languages. And now we have an Arabic version and the German version, Italian version in the works. So yeah, go and get a copy of the Physics of Bitcoin book. But I will try to have copies of the conference if people want a signed copy. Yeah, we both present over there. Anyway, so I have some announcement, and this will be basically my part of the show. I think you can see on the screen this what I have been working for the last several days, if not weeks. It's basically a dashboard. Right now you can actually subscribe if you go to our so the full site is scientificbitcoininstitute.org. Okay, all together. So go to the website, you will find it. There is a lot of interesting stuff. There is just explore it. There is a journal where you can actually see all our activities. Every time we go to a conference, we explain what we did there, who we met. It's important because it's a way, we want to be ambassadors, not just for the power law, but this approach, scientific approach to Bitcoin, explaining that is a worthwhile scientific topic. So we want to involve students, people in academia, universities, institutions, and so on. So look at our activities, all the different places around the world where we are going. There are videos where you can actually listen to some of our conferences or talks. So if you scroll down in the main page, you're going to see something that says become a member. Click on become a member, and there is a free level. Okay, it's called a reader. So click on, I gave some time ago some explanation, but I'm trying to repeat them right now. So you go there, click on that little button that say free reader. And what that gives you, it gives you access to a beautiful power law charts. You can choose linear, log linear. I think I can show you a chart how it looks. Eventually, like I say, members are going to have different levels of involvement. Let me see if where did I put this one? I'm trying to see a specific page within sharing. I can try to share something else. Okay, let me. I made a link, and then I forgot where it is. Okay, it is here. All right. So this particular chart, you see there is. Okay, yes. If we switch. This is what you get for free. Because everybody gets this level. So right now you can access it. Actually, I'm working on all the other elements. And these are on the left side. You see a preview some of the things that are going to fill this dashboard. There'll be basically almost anything you can imagine. In fact, maybe you are aware that I created about 15 different TradingView indicators. By the way, as you become a member, right now only the free level is available. Eventually will be access when I am finished with the dashboard. You can access 3 different levels. And these are, remember, are donations, right? So it's not really, we are not a company, we are a non-profit organization. We are both private corporate sponsors, but also we rely on the membership of the Bitcoin community. So hopefully, if you are a Bitcoiner, I think every Bitcoiner should sign up, because at least as a free member, be a free member, support, because even just being involved, participating, reading some of our material, will be a newsletter. And then, like I say, you can have access to this chart. I will show you the functionality of this chart in a moment. But then, if you want to support us, there is a $10 membership. If it is really inexpensive, that means you will get access to few of these indicators. And it's not just indicator, it's also different statistical graph, analysis, all kinds of different things that usually you don't find in other services, because again, we want to focus more on the science of all these analysis, not just some popular indicators that are useless. We want to give a scientific understanding of the data. Then there is a $20 and a $40 membership per month, and the 41 will give access to all kinds of material, and also you will get, if you prefer to go, so the dashboard has more information and has some functionality that you don't get in TradingView. Some people like TradingView, but with the membership, you will also have access to the TradingView indicators. Right now, I have a Patreon program. I'm kind of migrating that program to this membership. I'm basically donating my indicators to the Institute, and they will become intellectual property of the Institute. And then you can support, instead of supporting me directly, you're going to support the Institute. That is useful because, many scholars like me, Stephen, other people that are joining, but also students. We will have a scholarship for students. We're going to use money for that people donate to us to organize conferences about Bitcoin, create reports. We want to be very, very active in doing whatever it takes to support the Bitcoin cause, right? And I think because we are scholars, this is what we have to offer to the community. We want to push these angles, but we need, like in everything, you cannot do anything unless you have Bitcoins. Eventually will be a Bitcoin community, economy. Right now, cash also is helpful, until we go to the next system. Eventually, we will also, right now we don't take Bitcoin donations. I'm going to set up where you can pay your membership in Bitcoin if you want. And we will have also, you can always donate any amount that you like. But we want also to give perks, to the people that want to donate, because it's a two-way relationship, right? Eventually you can also do it in Bitcoin. Right now we are not set up, but you can pay in cash if you want it. It's not yet available. Hopefully, maybe in a couple of weeks, we will kind of launch this initiative. But this is a preview. So you're going to see there is a dashboard. Like I say, if you sign up, you're going to also to have access to the indicators in TradingView. So you can also look at them in TradingView. One of the things that I decided to have beside the TradingView indicators, I like the dashboard, because you see what you can do. You can have different views of different indicators. Like, for example, this is a classical corridor. There is the main, like a list regression type of fitting, and then different percentage of sigmas deviations from the power law. And you can see it in terms of a linear graph. So you can see these, like if you ever wonder how the power law looks like, well, it looks like this J, right? It's difficult to distinguish it from an exponential. We know that it is not an exponential, but it looks like a super parabola because x squared is a power law, and everybody's familiar with how it looks like a parabola looks like. This is basically x to the 6, so it's much faster. It's a super parabola in a certain sense. Then you can go to the log linear, which is the type of graph that everybody is familiar with. And then you can actually get the log. And this is very nice because the usual trading view approach is that you cannot do log of the x-axis. You can do the linear, you can do the log linear, but it doesn't allow you to do the log. But in the dashboard, you can, okay? And you can zoom in the chart, you can expand it. There is an expanding button, and then you can make the entire screen look like, you can look at the entire graph, and it auto scale. And the other thing, you can also click in here, that is usually something that you don't see in other indicators that I have seen in other similar websites. You can look at the residuals, right, with the statistical tool. So that tells you the distribution. You see this is the residual. So basically the deviation of the power law shows so there was, we had an entire episode on this debate about the floor that we discussed last time, in the last episode. So if you want, you can go and watch that episode. But there is a lot of discussion about, this mythical floor that everybody talks about, that, supposedly has been violated. There is no, first of all, there is no such a thing as a floor that cannot be violated. The thing is, you can see it by naked eye, that beside these kind of anomalies in the beginning that were also due to the fact that these were very early data where there was maybe some instability or whatever. Since then, the price has been very contained every time we went below the power law, and it seems to be contained within a very relatively small deviation, and see the deviation in terms of this sigma, like for example 1.41 sigma, right? So, and right now we are not even there because we are close to 1.2 sigmas, and so I don't know what people were talking when we are saying we are violating anything. We are not. And by the way, we say, this floor is not supposed to be something rigid where one single data point cannot go below that. It would be absurd, right? It's not a scientific way. It's a superstition to think that. It's not science. It's still science to see how close, right? You see, it is the distribution. That means how many data points there are above and below. It's asymmetric. There are more points here below than above. And it's actually a good thing because there are more and they are confined. They are within this sigma deviation. And this is not part of the power law. I want to emphasize over and over again because of the first level. So in physics, we have this idea of levels of understanding, right? We call it the lowest level possible, the highest level, let's say, kind of high-bird view, we call it zeroth level. It's like, okay, what is the most foundational thing that you can learn about this subject, right? The zero level understanding of something is that the power law basically say, well, there is this scaling behavior, and it doesn't matter how big the deviations are on the left and right side. If they basically the average to the power law, then this is it, right? In theory, they should be within order of magnitude, right? So order of magnitude means factor of 10, and this deviation above, they have been. Some of them have been even up to 15 times, right? So one order of magnitude above, but whenever we go below, we never went more than factors of few, like maybe 2.5 at most, so not even close to factor of 10. And the fact that they are constrained, it's another layer. It doesn't belong to the power law itself. It's something that you notice after you describe the deviation in terms of the power law. The power law is useful to identify this kind of asymmetry. It is interesting. It's something that needs to be understood why it is like this. And the power law helps to find out that there is this new, it's basically like another signal. There are two signals, right? There is the overall power law behavior, and then there is some structure. It's not random dots. There's some structure that is left over. And the way to understand that, a lot of an economist will say, oh, you don't have random data, so your model does. They will say all kind of weird things because they expect that if you have a trend, then what is left over is supposed to be random, right? Because you eliminated the trend. But it's not true, because if there is more than one signal, you eliminate one major signal, right? The dominant signal, and what is left over is another signal that needs to be understood as a secondary thing, and so this signal is structured in this way, where it's very obvious there is this asymmetry, right? So this graph is very nice because it tells you how the distribution looks like, where we are relatively to the distribution. See, this is going to be our approach. In this nice dashboard, we are going to have graphs that people can look at, but then if you want to go deeper, you can actually have this statistical analysis. We compare it historically with different deviations here, and there will be some explanations. Eventually, I'm going to have so this is why we have these additional kind of tabs here, because I want to explain. Right now, it's a placeholder, but will be an explanation of the methodology, something that, again, you don't find in many other websites that have some kind of similar dashboards, because we don't go in the details of the science behind, right? So you don't have to understand it, but if you want to go deeper, there will be an explanation of what we did and how the analysis was done, and the applicability, because when you explain it, there will be references, our paper, other work which we have done, similar work, and so on. And you will have also calculators where maybe you can calculate different things, like maybe projections of, like predictions for particular years and other things like that. There will be a lot of functionality. And if you want, because it's very important that you can do your own analysis, and maybe we can add here actually like a mini lecture where if you want to learn how to reproduce the data, we can show you too, maybe even using AI or things like that. So, it's going to be a work in progress where we add more and more functionality. But you can even download the data if you are interested, because then you can kind of double check it yourself. But anyway, so let me know in the comments, or DM me what you think about these. Like I said, there will be a lot of different indicators, but also, for example, we want to show how these indicators looks. If you have a BTC versus gold versus silver, maybe real estate and different things, So you can see how it changes if you change the denominator, because this is another criticism that people say all the time, oh, you're using the wrong denominator. No, it doesn't matter. It works with anything. It works with gold, it works with silver. But, one thing is to tell you, and one thing is actually to double check yourself. So it's a lot of work. Hopefully we are going to have a draft that is usable in a couple of weeks, and people then can sign up and have access to it, right? You can support the Institute in this way. Do you have any questions, Stephen?
I don't have any questions. I just would like to comment that, let us know what you'd like to see, and give us feedback as we, put up these different indicators and views.
Yeah.
So that we can respond to what's interesting.
Yeah, being a public organization, right? We actually, when I had to file for creating the institution, we had to say that we are a public good institution, right? We want to do good to the society. So we want your feedback. One of the reasons we want to involve the public and make them members, eventually we are going to have hats, all kinds of things you can go around and say, I'm a member of the Scientific Bitcoin Institute, right? Is because we also want to serve the public And so if you want to give us some feedbacks of features that you think are useful, eventually I think I want to do like a also way to apply the power law, maybe like a DCA indicator, like it gives you, okay, right now it's very good to go all full DCA, right? Maybe when we are close to a peak or large deviations above the power law, maybe you want to wait, right? You want to save whatever you are going to use to DCA for better times, right? You're still putting it aside, maybe in some kind of reserve, and then buy Bitcoin when actually is below the power law, maybe, right? So it's a weighted DCA that you could use. So will be things like that. But let us know, send us some feedbacks to me and Stephen, you know where to find us on X, and we can integrate these suggestions. This, for example, is the famous quantile fit. Again, you can look at it in the linear. Now, forget about the aesthetics. We are going to work on the aesthetics, the color, the shading. These are details. But the entire idea is that you can shift between the different ways of looking at it. Again, on TradingView, usually you don't see the log. Now you see the log here, and you see the different approaches. So we're going to have a different type of regression, Bayesian fit, different type of fit. So you can see how they compare, what they predict, all kinds of different information, tables, and methodology, and so on. Okay, I think it's a very good. Eventually, we are going to have also all the type of on-chain information, like hash rate, addresses, different models. Right? Remember, we are saying that the power law we see in time is a combination of active addresses and how the price reacts to it. So the Metcalfe law. So we are going to add here a graph that shows that the relationship between price and addresses. So you can check that. Where we test, right? In the paper we mentioned test to see if we are still in the power law. So will be somewhere here, one of the tabs says, health check on the power law. Are any of these things that we say they need to be violated for the power law not to be working anymore? It has worked in the past. It's not that it's going to invalidate the fact that we have another power law. I want to make that super clear. We have a power law until now, period. It's validated scientifically, but we maybe are not going to follow power law in the future, and we are going to have a health monitor for the power law that you can check. It will tell you, yes, no, we are, such and such away from the power law. There will be all kinds of different interesting information and functionality. And so it's going to be kind of, the Bible for anything power law related, but also in general, understanding Bitcoin. Maybe we can even add other more traditional indicator like RSI, etc. The problem is most of these indicators have little value scientifically, but we could maybe validate them, see which ones are, show even how they compare with the power law. Maybe together with the power law, they give us some more information. Okay. Anyway, yeah, I think I'm very proud of this work. It's a lot of work, and we're making progress. So let us know what you think. All right. Stephen, are you ready with your presentation?
Yes, I am. So let me put that up. Is that looking okay? How's that, Giovanni?
It looks great.
Okay, great. Okay, so the agenda today is I have this little test of acceleration of price, which it's a little tricky because things get noisy, right? But we have already demonstrated in the past that the velocity of price follows the power law. So I did a little test and in fact was able to demonstrate it. So that's, just something for a bit of fun, I think. The next one is log candlesticks, except they're not log, they're log. And you've never seen candlesticks like this unless you've seen my last presentation of them. You won't find log candlesticks on TradingView, and you certainly won't find log candlesticks. And I'll explain why 3 logs in a moment. But once you build those candlesticks in log space, then you can apply the Kelly criterion, the classical Kelly, to those candlesticks, and see how that compares with other measures of the Kelly criterion, and actually the variance of that. So I'll show that. And then I've done some surrogate testing on the log periodicity. So we have multiple ways to find log periodicity. We started out by looking at the distance between peaks, and we also looked at the distance between troughs, and we looked at it priced in gold. We looked at it priced in dollars. Then we looked at how you fit the entire structure of residuals, and there are different ways to fit. You can fit with FFTs. You can use wavelets. You can build these scalograms, which are, broad charts with color indicating how well a particular frequency is persisting. But the method that seems to be clearest for this is Lohm-Scargill, and that does pick out pretty strongly a fundamental. And it's like an FFT, except it corrects for the fact that the data that you're feeding in is all linearly spaced. And so it resamples it into log time before it looks for the dominant frequency. Then I've got a little tutorial on how you can calculate a z-score. And you could use this with historical one-sided volatility. I've got a little more sophisticated model with two-sided volatility and with the volatility coming down over time. But you could use this technique with simpler versions. It might have a step or two less. I want to show how you go through that. And then the other thing that I'm going to show is a combination of log periodicity on the residuals together with the financial conditions index. There is a little bit of explanatory power in the financial conditions index. It's not large overall, but on short timescales, it's rather good. It's rather responsive. So I will show you that. And that's a fast series, unlike liquidity. So it performs better than liquidity in general. Okay, this is the acceleration test. And the point here is if price is a power law, velocity is the first derivative of that. So that should be a power law of exponent 1 lower. So if our power law is 5.67 for the exponent time to the 5.67 power, then the velocity overall should be 4.67. And the acceleration is the second derivative of that, and that should be 3.67. Now you get more and more noise as you go, to these first and second derivatives, and in theory you could go beyond that. I didn't have any success with the next one, which is called jerk. But with acceleration, it works fine with the standard centered finite difference approximation, the equation of which is shown. You just look ahead by some window and behind by some window, and you take those values and the central value, and you can compute the second derivative, and you can vary the window size and see how you do. So what we have on the y-axis is the exponent. And since it's acceleration, we expect that exponent to be 3.67. So we have a blue dashed line running across that's at 3.67. And then on the x-axis, we have the log of the horizon size. And so I used horizons of 90 days, 180, 365, 730, and 1095. And the blue line with the error bars on it is the mean. It's the log age bin sine mean for these different horizons. And we find that it fits fine for 90-day window, 180-day, 365-day, and 730. even though there's a lot of noise, you've got bubbles and you've got crashes and troughs and so forth, but it's still working out with the smoothing. And, despite all that, it's recovered essentially, within the statistical noise, the power law that you expect. It's not as sensitive a measure as what we do, straight price against age, or even the scaling tests we do where we sample, all the points against each other, basically. But it's not bad. Okay, on to the log chart. So these candlesticks are not of equal duration, and also this is on a log chart. So we have the log of the price on the y-axis, we have the log of the age in years on the x-axis, and then the width of each candle is logged in log time, and that's why it's log. And this particular one is 0.1 spacing, and what that means is that each candle is at longer duration by about 26% than the prior candle, in order that we can just drop these onto a log of age. So each candle is longer time, and by the time we get up to 1.2, it's a few years. I think it's running from a few months to a few years as the duration as we go up. I think I've got a chart that shows you the details. I believe it's 4 years. And then I've put on here the pre-existing fits for ordinary least squares and for quantile regression median. You can see it runs through quite nicely, fits on the plot. But the other interesting thing to notice is that when you plot this way, unlike using annual candles, 9 out of these 11 candles are green. So you get an even better result. But of course, you're having longer and longer windows as time goes on. But that's appropriate for something that's behaving as a power law. Now, this one has much more detailed spacing. This is increasing. Each candle is about 2.5% longer than the prior candle, a bit more than that. And in this case, I actually did my regressions through the candles. So I took the midpoints and ran an ordinary least squares, and that's the blue line. And then I did another regression, which is basically using least squares on the candle bodies that are outside the line. And those two fall right on top of each other. They both give somewhat steeper power laws, 5.8 kind of power laws. And if you propagate it up to the present day, you'd expect to be at 160,000. So it's a little bit higher than what you get from a straight ordinary least squares today, which is in the 135 to 140,000 range. And now you see, of course, a lot more structure. You see the bubbles, you see the troughs, you see that candles tend to repeat, right? So you get these runs of green and these runs of red. So there's autocorrelation or some kind of structure underneath there. And of course, my argument is that that's log periodicity is a large part of that. This is a table that shows what happens is you change the log duration. So the first graph I showed you is a 0.1 log duration, and that's the first row. And that's a 4.4 years duration for the candle at present. And then I cut in half, and the fourth row is 0.0125. That's the chart I just showed you. And then you can do Kelly analysis on these. So first of all, the classical Kelly is just you take the percentage of wins minus the percentage of losses, but you divide the percentage of losses by this quantity B, and the B is the average size of a win, absolute magnitude relative to the average size of a loss. So if we just have the 11 candle case, that's the coarsest chart, we have 9 wins, 2 losses. And so already that's going to give us a very high F value, right? It's going to just give us something close to 9/11ths. We divide by B. B is also very high in this case, and we end up with a 0.8 So what that is a 2-asset portfolio that only has dollars, cash, and Bitcoin. If you are using this as your sort of decision point, these are your decision windows, then you could allocate up to 80% of your portfolio. That's what that is saying. The Kelly optimal fraction, it's the fraction that grows your log wealth the most rapidly. And you're operating quite at the edge when you do that. If you go beyond, then you drop off pretty quickly in terms of the actual expected gain in wealth. And then as we cut the window shorter, then the ratio of wins to losses, changes, right? And it becomes less favorable. It's 17-5 instead of 9-2, and then 28-16, and then 52-33, and so forth. So you lose some of your edge in the number of wins versus losses, and you also lose edge in this B ratio. There's more chance for the noise and the troughs to affect you. And so B drops steadily, and in the worst case, it's 1.6. And so the optimal allocation comes down to 0.7, 0.5, 0.4, and down to 0.34 with the shortest window. So that's the first test. The second test is called empirical F-star, and that's really just taking all of the series of returns and then finding, there's basically taking a product of 1 plus this fraction F times the return, and then finding the maximum of that, which is taking the derivative of that, where that turns over. And all of them turn out to be over 100% with that particular method. Not advocating that. This is not investment advice, but that's what it shows with that method. And the next one is what's called continuous Kelly. And it assumes there's an assumption of log normal or Gaussian distribution, which is the sigma squared in the denominator. That's the variance. And so that sigma is based on an assumption of log normality. And in the numerator, you have mu, which is the mean expected return. And we derive that directly from the power law. We know what that is once we know what the power law index is. And then we subtract the risk-free rate, which I just set here to 4%. So you actually observe the sigma, but you're making the assumption of log normality. And then what you find is somewhat similar results to the classical F test. Maybe it's a little bit higher allocations that you get, 0.9 initially, it bumps up to 1 just for some statistics happening, and then back to 0.5 and so forth. So it's broadly similar, but higher allocations. And then the next to last column shows you the duration of each candle at the very end, depending on how much resolution you put in there. So you could say that, with many candles, this 0.00625 kind of allocation, which would be, 1.5% increase in time with each candle, that's really the speculator category. And then you go up to trader, active investor, and then stoic, is the long-term composed investor when you're at 4 years kind of horizon. Now, an interesting thing is that the continuous Kelly fraction increases with Bitcoin age. And I'm not suggesting you run out and allocate what this shows, because it's very high results. And this is only taking into account some assumptions about how volatility is falling and projecting those out. But right now, the volatility is 42%. I did a fit to the historical volatility. And if you don't do it two-sided, if you just mush it together for both sides, then it falls as 1 over age plus 8. Now, the mean return with the power law is roughly the first order. It's beta, the power law exponent, which is 5.7, divided by the age. So that gives us a mean return right now in the high 30 percentile. But for the continuous Kelly fraction, you divide by the variance, which is the square of the standard deviation. And that's falling with time roughly as the reciprocal of age. And that means the ratio of mu over sigma squared is going to increase with time. And it has, in fact, been increasing since age 10. So, you know, half Kelly, quarter Kelly take you down below 100% allocations. But the broader message here is that even though the return expected from the power law is dropping, volatility is dropping as well. If you take a Sharpe ratio, you find that they're basically heading towards some constant value out in the distant future, because that just goes as mu over sigma, mean over standard deviation or volatility. But this continuous Kelly fraction goes as a square of that, and the denominator is the variance. So you end up with something that looks like it's rising with time. And so you can feel comfortable about your portfolio allocation if it's on the high side. Okay, this is log periodicity. And using the Law-Scargo method that I already described a bit, like FFT, but log time spacing. And you run this on various data sets, it basically comes out in the 8.7 to 9, you know, depending on whether you're looking at gold or other peculiarities of the data set. This fit gave a very sharp fundamental at angular frequency 8.72. And you can compute what the log periodic spacing parameter is from that directly. It's just 2 pi over omega, but you have to exponentiate it and you get 2.06. And whenever we do this, we find log periodic spacing values that are constrained, that are in the range from 2 to 2.1, but kind of centered around 2.04, 2.05, 2.06. It's very strong. We do see some harmonic activity up around angular frequency 15 and angular frequency 20. Those are not integer harmonics. There's a dotted vertical line up at the first harmonic, which is 2 times the fundamental frequency. And they're not sitting on that. They're sitting below that around 1.7 times the fundamental and up around about 2.25. And then the inset is called a wavelet ridge. And it looks at how this fundamental frequency for log periodicity is developing over time. And we find for the history from 2011 to 2026 that it was sloping upward towards 9 and then has been gradually falling back towards age. So it's been pretty stable, but there's been some variation, and it seems to have kind of locked in, particularly since 2022 at closer to 8 than to 9. And I did, this is the gold standard for the Law-Scargo for surrogate testing. I ran 500 surrogates. Here's the observed omega and lambda as before. And the peak power that we saw from the prior slide is 0.33, and that is log 10 price residual. That's the units there. And then what we find is for the surrogate, the mean peak power was less than half. It was 0.14. The median was 0.13. And the 99th percentile was pretty much matching where our observed peak was. It was a little bit higher.
And let me say this is actually very important test, because Sornetti itself, it is actually the father of all this log periodic understanding of data. He didn't apply it in the way we applied. He applied it to local event, local bubbles or local bottoms, but it's a very powerful tool, and so people look at it in a very skeptical way, and there is some literature that actually push back, and some people claimed, oh, you can get log periodicities basically by chance. And one of the tests that was proposed was exactly this, like you run some data that has some statistical similarity to what you're looking at, and then you do it over and over again, and look at all the possible log periodicity that you can get with different frequencies, And this is basically what you get. You get a random spectrum, and then you compare it. It's going to have some kind of a peak. It is the most likely place where this fake low periodicity show up, and then you compare it with where the peak of what you're observing looks like. And this is a very powerful test that in the past people have used both, as, okay, yeah, maybe you have a point if you're observing something that looks away from this peak, and as a general criticism, right? Where be careful, because you can get don't immediately say you're observing a low periodicity if you don't do this test. So it's one of the most fundamental tests that we need to do. And eventually, when we publish these results, this will be one of the things we need to introduce in the paper, because otherwise, immediately get by the reviewers, they know their topic, pushback, have you done this test? So the data passes the test. That very interesting, a very important thing.
And this is current data all the way through recent. I can't remember right now the cutoff date, but it's very recent. And so all of the rundown since last October is included in here. And the test produces two probabilities. One is the maximum band power. And for there, we're in the 98% percentile. So it's 0.022 probability that you could reach it by chance. And the standard is to be less than 5%. And we are, by more than a factor of 2. And the other one is the power at the observed frequency. So at that peak frequency of 8.7 for omega, how much power is there randomly? And we're better than 1%. We're 0.006%. So the two key tests fit quite well. And you can see the solid line, in the histogram shows where we actually are, and it's way out in the tail. Okay, and then this little tutorial on how you can compute a z-value. And in this case, it's for two-sided. So I take the residuals and I fit each side with an envelope for the amplitude. And so the orange line is only for positive residuals, the green dash line only for negative residuals. The power law has been subtracted out. These are log 10 price residuals. And so the positive envelope has an R squared of 0.66, and it's a reciprocal plus an offset of 2.5 years. And it's a more rapid decline for these bubbles. And then for the troughs, it's a slower, and for the anti-bubble regions, if you want to call them that, it's a slower decline, but there is some reciprocal with age decline, and with an offset of 8.8 years, and the R squared is not quite as good, it's 0.45. So the 7 steps are, you put everything into log age, you do the power law, you compute the residuals, and then that gives you basically this plot. You fit the envelopes on the two sides. And then once you have the equations for these, and you could try to fit them with just power law declines, and in some cases you can get a fit that's about as good. But these are reasonable, these sort of reciprocal plus offset models. And then you convert them, because this is a mean amplitude, so you've got to convert them to a volatility. And you do that just by multiplying by a constant factor, which turns out to be square root of pi over 2, 1.253. And then once you do that, you can calculate the z-values by just taking the residual divided by the reciprocal. And then you can do a table lookup or ask AI to tell you at that z, what's the percentage level. So here are the details for actual data like a couple of days ago. It would have been on the 12th of July, which actually I think was the last data point for here. So the log age was, the age was 17.5 plus 9 days. which is 1.244. Once you take the log, you plug it into the power law, and you get a log price of 5.141, which is $138,000. Then you calculate the residual. The price at that time was $64,000. You divide by the $138,000. You take the log 10 of that, and you say you're 0.335 and for your residual below the power law. And then you pick the right envelope. You're on the negative side, so you pick the envelope for the negative side, and that tells you your amplitude for the current age, given that declining amplitude, or it's getting closer to the center line, works out to be minus 0.13. You have to convert that to a sigma, a standard deviation, by multiplying by this factor. You get 0.16. So you've got a residual of minus 0.33. You've got 1 sigma is 0.16. And so the calculated Z value is minus 2. So if you do local and two-sided, you'll get a different Z value than if you just do the total history and munge everything together without discriminating between the two sides. In that case, you get like minus 1.4 or some number like that. But this Z of minus 2 tells us we're about as far down as one could expect to be. And you can kind of see the history anyway. When you look that up, the percentage is 2%. So it says we're at the 2% level. But I just wanted to step that through that to give people a feeling of how you do that, and so you can do it at home for yourself. And then the last thing is log periodicity plus adding the financial conditions index. And I don't have everything broken down in terms of the fundamental. This is the total model, but it's got the fundamental and 2 free harmonics. And for this particular fit that also included the financial conditions, those 2 harmonics were 2.2 times the fundamental plus 2.72 times the fundamental. And the R squared for this total fit that included the financial conditions is 0.47. And of that, 0.12 came from the financial conditions weekly series. And in fact, there was a lag. That is, the financial conditions lead the price. And I searched to find the best lead lag, and it turns out to lead by 2 weeks. So this chart shows it leading by 2 weeks. Total R squared, reasonable for a financial series. It's explaining about half the residuals, and this is what we typically find. And then the other half, you say, is due to a wide range of exogenous and stochastic effects, and that could even include some linear component for halvings, as there is a small linearity there, and liquidity, or all the macro variables, or exchanges going out of business, or something happening with master strategy. Many causes. Now, it's interesting, if you go fit within 5-year windows, you can get even better fits. And it's reasonable because for the log periodicity, both the fundamental and with harmonics, we do have decay and amplitude, and we can have phase shifts. In this case, I only have 1 harmonic, and I do also have the financial conditions, and I fit for the best lag within the window, and that was 9 weeks. So this is the recent 5.5 years, and it gave quite a good R squared, 0.9, including all those terms, fundamental plus 1 harmonic, plus the financial conditions. And the financial conditions, you can see, are kind of giving you the zig and zag. The dotted green line does not have the financial conditions, but you can see it does fit the general shape well, including the decline that we saw, as we got into the fourth quarter of 2025 and through the present time. And you can make a short forecast ahead because of this 9 weeks. So there's a short forecast made. And then in that little intercept, the sort of long, thin diagram, I've linearized that, and it just kind of bounces around $70,000 for the rest of the summer with that one. but a very wide band, with the sort of 1 sigma gray band going up above 80,000 and down to somewhat below 60,000. So we're sitting in that broad band. And then the other chart in the lower right is for the first 5 years, first 5.5 years. And that one gave an R squared of 0.65. And the middle 5.5 years also gave about a 0.6 R squared. So by fitting these harmonic modes more locally or more intermediate timescales and financial conditions, you can tune a bit and get somewhat higher R squared. Okay, read Giovanni's book, read our white paper. It's now got 13,000 downloads. And of course, not our white paper, our published scientific paper that's in the Nonlinear Science Journal as of June 29th.
Okay, fantastic. Very, very nice presentation. I love it. Very interesting results. Publishable results, but hopefully we will publish soon as going deeper in all this understanding of the power law. Okay, we can look at maybe some questions. To be honest, I don't see any questions. Mostly people asking for the site. So the site is scientificbitcoininstitute.org, not .com, but .org. And explore it. There is some people reported they have problem with the email verification. Check the spam, and some people even don't find it in the spam. I'm going to fix it. I'm going to see what is the problem. So double check. Don't give up. This is what happens when you do something new. Not everything works immediately fine. There are all these details. I'm trying to use AI for everything because we are trying to be very conservative in how we do things. So we don't have a huge big team. So be patient, double check if you have some problems. Maybe there is a way for me to know that you try to log in, and then I will see if I can resend to all the people that sign up an email to validate. But I will try again in a few days if you had some troubles in signing up. Okay, and I think we will have our first newsletter sometime next week, early next week, and then every 2 weeks we will have a newsletter with me and Stephen and other people are going to work on. All right. So we do have a good question. I would like to know when you guys will expect to cross the median again. What your models say, Stephen?
Yeah. Well, we'll probably have to wait a while. I did show.
You have a graph?
No, I did look at that last week, our last show, and it's a very broad distribution. So I looked at how long it takes to return after you cross and hit a low, and we just had our low recently, right? Mm-hmm. And so the average was around half a year to get back to the power law, but the distribution is very broad, so it's quite uncertain. It can be faster, it can be slower. The longest ones have been over 2 years, and the shortest ones have been, in the months.
Yeah, in the past, roughly, it took 1 year to go from the peak down to the bottom.
Right.
Then we actually spent 2 years. Once we reached the bottom, we spent 2 years. But you have to understand, in that 2 years, it's not that we didn't do anything. We still moved along the power law. Because if we move along the bottom, and that growth is parallel to the power law, we are still going up. We are still going up as we are supposed to go up, and then the fact that we are above or below the power law is not that important, okay? Because in general, the trajectory is given by the change in the price into the returns. And the returns are actually consistent. They are stable in time. So this is one of the things that probably needs to be explained better, because I tried a few times. People pay so much attention to where we are relatively to the middle ground, right? But the middle ground is useful because usually we are above or below it, but it's not really the full story. The full story is the derivative, like today Stephen was talking about. We're following the derivative, and that happens even during the bear market. In a sense, we never have a bear market because of that derivative is still going, right? So it's basically like this. We are moving along the bottom for whatever amount of time, then we jump, we go close to the middle or even above it, and then we go below it, but the average value of all this behavior is still moving along the power law. So that is the signal, the real signal, right? So it doesn't matter too much. I know it feels psychologically better to be, because it's kind of like feels safer, right? If we are close to the middle than if we are to the bottom. But what really counts, how they change in returns. And that will be actually one of the metrics that you're going to find in our dashboard. And I didn't look recently, but I can tell you just by eye that we are basically following still the power law. The changes of the growth, the derivative is still what you expect if we follow the power law. That doesn't change.
I could give you a little more color on this, which is I did look at the growth of the log periodicity, the best model for it. And right now, the 1-year projection for that is that you would get something like 35% growth due to the log periodicity on top of the power law.
Yeah.
So it basically would double the power law trend over the next year as the mean expectation, but with a lot of uncertainty.
Yeah. Everything is fine. So there are no signs that we are doing something different from what we have been doing for 16 years. So hopefully we continue in that way and take it as an opportunity to actually buy cheaper Bitcoin. That is the idea. Anyway, guys, I'm ordering one. I moved. When I am in San Diego, I have a professional microphone. I don't have one yet. It's from my camera, and I'm going to buy one. We identify a good microphone too. It's in our list of things to do. Thank you for the feedback. Yeah, hopefully next show we will have a microphone, a better microphone. Okay, guys. Thank you so much. We will see each other next week. Okay.
Thank you, everyone.
Putting the comments in this video on YouTube or also on X. Send me DMs on the dashboard. What do you think? If you have any wish list of things that we should add, we will try to integrate. Okay. Thank you so much, guys. See you next week.